Okay, welcome back. We are heading into a pre-opening session which could be positive, continue to take trend forward from yesterday. A lot of good numbers coming through, and Prakash Diwan is still sitting by with us. Prakash, I wanted your thoughts on how one should approach something like an HUL now after the numbers, right? I mean, there was a slight miss in volumes. Margins have been under pressure, below estimates. For someone who's perhaps holding HUL, should one churn out or should you continue to stay invested?
So, Sonia, I think if you the choice to move out of HUL gets compounded because whatever you land into, if it's within the FMCG pack, will also probably see very similar, if not identical, stresses. I think the inflationary pressures are very clearly very large and looming for all of them. But what's the silver lining here is that if you continue being invested into an HUL kind of a story, all the cost control measures that the companies have incorporated, whether it's lower A&P, whether it's packaging efficiencies, supply chain dynamics, all of that will actually start helping out once the commodity prices ease off. Whether it's crude, whether it's raw material, agri, inputs itself. So once that happens, you'll probably see all those synergies, all these cost efficiencies actually playing into the margins favorably. So I think it's best to stay put because these stories are far more resilient in the long term. And you've seen the likes of Nestle and all, they've gone through so much of turmoil and then bounced back. So it's best to kind of stay put. The only stock in that space in FMCG or consumption by, if not FMCG, which I think is has been encouraging the numbers from is United Spirits. We saw the numbers. I don't know if you've discussed that, but I think that's one business that's likely to kind of reshape itself into a very promising franchise as it grows. They finally come to a stage what they wanted to. Diageo always wanted this premiumization, and it's kind of neat and clean, very premium. The prestige segment is growing. So if you had consumption as an allocation pocket, you probably could look at this, and this could probably be a multi-bagger in the next few years to come, is my guess. But of course, they're not like to like in that sense. But stay put in HUL if you are happy with a long-term orientation on that.
Point taken. Prakash, thank you very much indeed for joining us this morning with your thoughts on a bunch of stocks. Take your premiumization point. Even in United Spirits, it's premiumization that's doing well. So all this is adding a bit of evidence that the bottom of the pyramid is in pain, which is why other FMCGs are not doing as well. But that discussion for another day. For the moment, it's going to be bank earnings. ICICI Bank posted a strong set in the second quarter. Net interest margins coming in at, I think, an all-time high. I don't remember 4.3 in a long time. Loan growth, the best in, 6-7 years. Kotak Mahindra Bank also very good net interest margin, a multi-year high at about nearly 5.2. Loan growth strong, 25%. Krishan ASV, the lead analyst for banking and financial stocks at HDFC Securities, with us. Krishan, good morning. Happy Diwali to you. Well, first up, ICICI Bank has also been backed by the markets for this extraordinary performance. But with this performance, does it still remain a buy? What are the fresh price targets?
Hi, Lata. Very good morning. Wish you all a very happy Diwali with CNBC and your viewers. A flawless performance, near flawless performance. You have to really cut through the comb to get to something that you can flag off. And the only bit I would worry about, Lata, is that a lot of this is asset repricing, which is happening, which is very accelerated as well, right? So while directionally we always thought NIMs will reflate because EBLR, etc., the magnitude of reflation has been a surprise. So we went into Q2 assuming a 15-20 bips kind of margin reflation. It's actually surprised us nearly double of that, right? But the only thing which we internally say as well, and most of our publications carry as well, this is a very benign credit cycle and too good to last forever, right? And so when an ICICI Bank is actually able to save for the rainy day, when it's able to put aside some profits for what might go wrong later on in the cycle, I think that augurs very well for the health of the bank. Right? So Yeah, I mean, we are extremely enthused. It has remained at the top of our pecking order for about 4 years now, 5 years now. And I still continue to see that they are running away with the lead. So now that lead is only going up. Obviously there's one bank which we can't comment about, but outside of that universe, I think ICICI Bank continues to pull away into the lead.
Okay, so leader of the pack continues to be ICICI Bank. On Kotak Mahindra Bank, do you think that the valuations now capture the optimism in earnings, and how do you approach that one?
So there again, I think most of the banks in the system today are running at about a 20% plus loan growth and only a 10% deposit growth, right? So very easy to report a 5% margin. If you start with 4.9, very easy to reflate your margins 30 bips if one side of the balance sheet grows much faster, and that is repricing itself much ahead, right? I think in Kotak Mahindra Bank, the challenge on deposits is going to be a little more acute. They are running at a 90% loan to deposit ratio today, right? ICICI Bank is at about 86. There are other banks in the late 80s right now. So a lot of these banks which are actually looking at market share gains on the loan book side can only do it now if they raise their pricing on the deposit side as well. They have to up their game, right? It's not just going to be a pricing game, but it's also got to be an efficiency game. Not every bank is used to raising deposits and mobilizing deposits at pace. So either loan growth will have to then align itself to a new reality of deposit growth, which means, slowing loan growth. So at 25% for Kotak may have to settle down probably in the late teens then, right?
Yeah.
Today, it's very easy to extrapolate 30 going to 25 and staying at 25. I think deposit growth is not allowing us to take that call today.
Okay, that's right. Speaking of deposits, a bunch of mid-cap banks also announced numbers. Yes, RBL, IDFC, a lot of them coming out of trouble, or at least hoping to coming out of trouble. Would you, say if you were to divide banks into three levels, we discussed the top echelons. There is a middle level, comprising the federals and, the BOBs. Maybe BOBs in the top echelon now. But there is the bottom of the pack. Do you think there are buys over here now because of the benign cycle and their performance?
So as I said, among the larger banks, very clearly ICICI Bank.
Yeah,
and
that
SBI
is not even worth discussing now. It's like axiomatic. That's why I'm coming to the bottom half.
So the mid-sized banks, Federal Bank and City Union Bank are top picks. I think Federal Bank has a franchise deposit which will continue to be at a premium in this kind of environment, right? They sit doing nothing, even then deposits will flow in. Not too many banks can actually boast of that, right? I think they would be very close to an SBI there.
Wow.
But, among the mid-sized bank, those two would be our top picks. Federal Bank and City Union Bank. I think a lot of others are in their journey to kind of, finding their feet, both in terms of profitability as well as, optimization levers. I think Federal and City Union Bank would be the most mature at this point.
All right, Krishnan, we've spoken about the banking names. Just one final question before we let you go. Reliance has announced, the demerger of the financial services business, and they're looking to build a digital financial services enterprise. My question to you is on the NBFC space. Do you believe that there is some kind of threat to the valuations because of this entry, or do you think that's too far-fetched a thought?
Too early. I wouldn't say too far-fetched, but too early because, look, some of these NBFCs, and there's only probably one NBFC which has built consistent gates in terms of the digital bridges that they have done. That would be a Bajaj Finance. We do have a reduced stance there, but competitive intensity is a reality, right? If competitive intensity means that profit pools begin shrinking or revenue pools begin shrinking, then definitely multiples do come under pressure. But I think that's still very early days right now. Just an announcement does not really materially change anything. Lots of other NBFCs have tried their hand at doing what a Bajaj Finance does. It's not been easy.
And what is the current multiple you're giving to Bajaj Finance?
We are at about 7 times.
Okay.
Yeah.
Okay, all right. We'll leave it at that, Krishnan. Thanks a lot for joining in. By the way, the pre-opening rates are also settling now, and it's looking pretty good, actually. The Nifty is now up almost 77 points in pre-opening, and it's led squarely by ICICI Bank, up about 1.7%, Kotak Mahindra Bank and Reliance. In fact, all the result reactions are on the upside this morning. Reliance is up about 0.7%. Infosys has made a big comeback this month. It's up about 9% this month already, and the stock is up about 0.6% right now. In fact, it has a lot of other technology stocks for company. TCS is also up in the green. But let's continue to discuss about earnings. Credit Access Grameen is the first corporate that we're speaking to today. The net interest margins have expanded to 12%, and high write-offs continue to aid the gross NPAs this quarter. Uday Kumar Hebbar, who's the Managing Director and Chief Executive Officer at Credit Access Grameen, joins in now to talk about that. Mr. Hebbar, good morning. I want to understand what the loan growth targets are for the full year, because demand has come back in a big way, especially in gold loans. What is the expectation?
Good morning and happy Diwali to everybody.
Happy Diwali to you.
We guided about 24 to 25% loan growth this financial year. And if you see today, as of September, we grow 24%. So that means we are on track in terms of delivering AUM growth of 24-25%. Gold loan is not our focus. We are on microfinance as a key 99% of our book. Maybe gold loan we are piloting, but we don't know. Probably the traction in terms of portfolio would come only next year or so. Okay. in terms of gold loan.
Oh.
But early JLG, 97% of our book is JLG, and it's a good traction there. We believe we will be able to deliver the guidance what we gave about 24-25% without any difficulty.
Okay, all right. And your ticket size has been stable at around 45,000 odd, so 45,000. So I'm guessing that majority of the volume, the growth that you're talking about, will come in from customers, additional customers, and on the volume front. We get that on the loan growth. But my question to you, Mr. Hebbar, is on the NIMs. A large part of your borrowing is from banks. If I look at your standalone entity or even on the consolidated basis, and the cost of borrowing is going up. Now, you have said your cost of borrowing has gone up by 50 bips approximately. The RBI's hike rates by far more. Your NIMs are at around 12%. Do you think there's a downside risk from here? And also, I believe you're looking at changing your borrowing mix. Could you explain that to us?
Absolutely. So NIM, there won't be stress on the NIM because we have ability to pass on in case there is a further increase in the price. But if you look at last 6 months, our average cost of borrowing has gone up only by 30 bips, despite that's a large increase in interest rate by different banks because of the mix what we are using in terms of bank borrowing and international borrowing together. So our average cost of borrowing is not increased so much so far, and we are not believing that there will be large stress on the NIM because we have ability to pass on the pricing in case there's increase. So therefore, the 12% NIM should be intact for the remaining part of the year. And from a liability point of view, it's important to build long-term and stable liability with the diversification. Therefore, we are already working on many things in terms of internationalizing the borrowing. Almost 12% of our borrowing already international, and then the pipeline borrowing and undrawn sanctions, almost 20% are international, which gives us a long, stable funds and a diversification beyond borders. This is very important for a growing microfinance book. In the same time, it may lead
Mr.
to costly borrowing. Yeah, yes.
Mr. Hebbar, just want you to repeat that. You're saying that international borrowings is how much? 12% as of now. And you're
currently,
and you're looking to take that number to
20% actually. So our fresh borrowing, almost 20% is international borrowings.
Okay. Now, I don't worry so much about your liability side at all, Mr. Hebbar, but if you can give us a little more color on the asset side. We hear about pain in the bottom of the pyramid in rural areas. FMCG companies are reporting 1% volume growth. Would you worry if, any part of your loan book can suffer some kind of asset quality pain, especially if rates go up?
So not really, actually. So if you see today, we are competitively positioned to give a what you call suitable pricing. For example, in the microfinance segment, we are able to price much better than the competitors.
Mr. Hebbar, no, not just pricing. It is the ability of the person to pay. I mean, if the economy slows, say if the textile sector slows, I mean in terms of availability of jobs and good salaries.
I'll come there. See, microfinance is for the self-employment in the bottom of the pyramid who are in some kind of business. So their ability to pass on the cost to their customers is very high. That's why whether it's inflation or cost of borrowing, most of the net neutral for them or net positive for them. So we observe that our customers are not what you call suffers because of a slight increase in price or the inflation, because two are the components which you must be talking about. But what we observed in the last 12 months, so there's a good positive movement, there's a good demand, and then therefore we are not seeing any difficulty in this area for our growth and achieve our annual guidance.
Okay. All right. We'll leave it at that, sir. Thanks a lot for joining in and giving us an update on the business. By the way, just wanted to mention that the pre-opening rates are settling much higher, almost 80 points now in the green for the Nifty. It's ICICI Bank that's soaring from the front, and it has Kotak Mahindra Bank for company. Remember, a lot of brokerages have in fact raised their target prices on Kotak Mahindra Bank. Citi has a target price of 21.20 now, and HSBC has raised it to 20.30. So most brokerages are above the 2000 mark. So Kotak Mahindra Bank looking pretty good. But NMDC also in focus this morning. Nigel, why is that?
Well, they already announced on the record date. Remember, they're demerging the business. They'll be having their core iron ore business and also the steel business. That's the Nagarnar business. We'll have two listed entities separately. For now, we'll be focused on the record day. That's on 28th of October. We know tomorrow's a holiday, which I'm very happy about. So effectively, the ex-date is on 27th of October, which means that today is the last day to buy the shares if you want to be part of both the entities. It's the core business as well as the steel business. Remember, the demerger ratio is a replica of what it is, 1:1. If you have one share of NMDC, you'll get one share of the steel plant. And in terms of a valuation, they've already spent close to on 20,000 crores odd. Depending on what the street wants to give in terms of a valuation, you give it as a percentage of how much they've spent. It could be in the vicinity of around 30 to around 60 rupees odd. So expect some bit of action on stock, particularly towards the end of day, because today is the last day if you want to be part of both entities to buy it.
Okay, we just have about 30 seconds left for the markets to open. Reliance Industries is also interesting. So on Mahura Day, there was a little bit of a red tick there. But right now, Reliance is up almost about 0.7% as we head into a bright new day of trade. Of course, the street perhaps likes the fact that the consumer-facing businesses, which is the future for Reliance Industries, have done very well, both Geo as well as retail. So that one's looking good. And then a couple of these auto stocks, Maruti, Tata Motors, are all in the green as well.
It's a bit under pressure, and bond yields are slightly higher, I guess because of the crude prices being higher. And there goes the bell. Up about 1/3% for the Sensex and the Nifty, and the Nifty Bank as well. I thought that would take a bigger lead, but at the moment it's just neck and neck, maybe slightly a nose ahead. ICICI Bank is still leading, 1.3% higher. Actually, auto stocks are doing well. Sonia would want to hear from you about that. Eicher Motors, Tata Motors, all of them in the lead, the top two gainers at this point in time. Apollo Hospitals is also one of the top gainers, Sun Pharma. So it's actually quite a mixed bag. And then coming up with Infosys. So you have pharma, you have IT. It looks like the global-facing stocks are seeing a bit of short covering, clearly because developed markets seem to get a reprieve of liquidity. And then, of course, there is ICICI Bank. What's not doing well, Axis Bank is seeing a bit of long unwinding, I guess. There was a lot of buying. Metal stocks not doing too well. JSW Steel and Hindalco in the red. The Bajaj twins also not among the most favoured. Bajaj triplets, if you please. Bajaj Auto also not participating. So it's not a steel day. It's not a metals day. And, okay, also not for Bajaj. And oil stocks also not doing too well. Understandably, because crude prices are higher.
Absolutely. In fact, in the broader markets, the mid-cap index is slightly under pressure now, down about 65 odd points. But just want to mention certain stocks. KEC International has won a big order, and that stock is up almost about 2 odd%. You have something like a VIP that posted a very strong set of numbers. The sales are now 25% above the pre-COVID levels for VIP. So that stock is down. Maybe some profit taking is what you're seeing there. By the way, it's fresh record highs for ICICI Bank this morning, so don't lose sight of that as well. At 9:39, it's a fresh record high there. A lot of consumption stocks are doing well. Devyani International is up almost about 2.5%. You have a lot of pharma stocks, Janta Pharma, Dr. Lal Pathlabs, Krishna Medical, all in the green right now. Aster DM as well, flat with a bit of a positive bias over there. So not bad, but the Bank Nifty is now dragging its feet. It's moved into the red, led by Axis Bank, IndusInd Bank, So it's like, a tale of two cities. ICICI Bank on one hand, Axis Bank, a little bit of profit taking, but otherwise nothing much to complain about.
Well, that's right, Sonia. But, it seems there is a fight at around the 17,800 odd mark because the Nifty has almost moved into the red. Yesterday, we went to around 17,780 and from there we did a U-turn. Today, we made a high from 17,811. So from the highs of the day, we are down close to around 70 points. The Nifty Bank, well, that's corrected close to around 250 points from the high point of the day. So clearly that program trade seems to be playing out and some money being taken off the table after the kind of run that we've seen. A couple of stocks that I'm looking at, Tata Motors, DVR. Even yesterday, the stock did much better than what the core stock, that's the Tata Motors stock did. It's up close to around 2%. Remember, yesterday it was up close to around 8% by the time we wound up. MCX, it had a good run yesterday. Today, it's seeing some follow through. So it's up close to around 2.5% odd. So that's one of the big winners. And the IDFC stocks, both IDFC First Bank as well as IDFC, the numbers look pretty good. But both those two are coming for some profit taking. And RBL Bank, yesterday it was down 3.5% in a strong motor trading session. Well, today it's down another 2%. And as we speak, all the frontline indices in the red, the Nifty Bank, the mid-cap index, all of them trading with a tinge of red.
Before our stock expert joins us, Nigel, is this a typical expiry behavior?
Yeah, that's right. Lata, a couple of factors actually. Yesterday we went to this high, right? 17,780. Now, given that tomorrow's a holiday, there is that, that temptation to go ahead and take some money off the table. There'll be some rolls as well that'll happen. But for the time being, 17,800, going by the kind of action we had yesterday, which we pointed out early today, the highest open interest on the call side was at around 17,800. Clearly telling you there was some writing on that front. So I'm not really surprised that the 17,800 mark was met with some selling. Now the interesting aspect will be, do we go back down to around 17,600 or do we see at around 17,700 that dip gets bought into? That's going to be crucial.
This is the expiry of the month.
Yes,
so it's
of
an
the
important
month. It's a big one.
Thursday.
It's a big one, right.
I also want to mention, the KPIT Technologies was clearly the stock of last week. It had a fabulous run. Now the stock this month is up almost about 15% and this morning as well. After the company raised its guidance, KPIT Technologies has been moving only one way and that's upwards, and now as well up about 2.5%. All right, we have our market master of the day, Ajay Srivastava, the CEO of Dimensions Corporate, joining in now. Ajay, happy Diwali to you. It's been a good somewhat.
Thank you. Good morning.
At least the start has been pretty firm. How are you feeling about the new year and what is the expectation as we move along?
Well, I think it was a good last year. Nobody can complain about the last year, and I think it's going to be is a good summer this year. But only fact is, depending on from where you look at the whole market, it's like an economy is like a glass half full. Some people feel optimistic that, listen, the worst is behind us. Some people can feel pessimistic that the interest rate and inflation will come through and the demand is going down. So it just depends upon where you look, from which side of the market you look at it, and you decide whether you want to be optimistic or pessimistic. But one thing we know for sure, and I think that's what the market has taught us, is that the paradigm of this long-term investment concept is gone now. I think you need to learn to be flexible, fast, nimble, and get out of stocks once they reach a good point of valuation from a comfortable point of view. Sticking with them is not a good idea. Like say ICICI Bank. 1 year back, it was 850. Today, it was just before the rise happened, it's 850 1 year later. By holding stocks for years and years, I think that's where now the paradigm has changed, that model needs to be tweaked by investors. And you can never have a better opportunity. Equity markets doing well, debt markets doing phenomenally well. What better can you want from an investor standpoint?
ICICI Bank, I thought, is all-time high. I guess you would bother that over the year how much has been the gain. But Ajay, have the banking stocks reached that level? The consistency of the performance is such that it seems to merit, even more backing. You don't think so?
Well, okay, Nada, I would have answered yes categorically. That should be the general answer if the loan growth is 27%. If we knew the RBI policy and if elections were not in FY24. I think, whether we like it or not, higher interest cost which the banks earn and therefore the profit has gone up is an input cost in the economy and the rest of the economy. Now, it depends upon the RBI policy, what they do at the end of the day, that should they just, tighten up the spigot for liquidity and ensure the savers get more money, economic spending goes up. And, so it just depends on where RBI stance is going to be at this point of time. It is very clearly, one answer is very clear. The banks are heading into a bigger risk than they ever thought of. because where the interest rate inflation is, their personal loan portfolio will be at risk in the next 6 months. They cannot be sitting outside because people are not making enough money to battle. You got to meet your ends first before you pay the loans. So the big personal loan problem default is going to come in the next year, whether we like it or not. And you want to price it now, or you can ride the tide up to January and maybe sell off. That's maybe the one way to approach a banking. But certainly you would not be like to be sitting banking from here till June or next October, because the personal loan problem will start to surface. The restructured loan, MSME loan will start to come out in the next year. The Mudra loan will start to show up into the next year. So you don't want to be sitting there when all these things start to come up. So ride the thing. I agree with you. You may ride the thing, but there will be a point when you need to get off the pedal. Otherwise, point to point, you might be quite disappointed.
Okay, all right. Not a bad time to take some money off the table on the banking names. Ajay, morning. Nigel on this side. Thanks so much for joining
Good morning, Nigel.
Ajay, I wanted to ask you about the real estate space. The stocks, obviously, they're a far cry from what they were 10 years or so ago. Now you have the rising interest rate scenario that will play out as well. Yes, there's been inventory liquidation, which is good news. The sales numbers are looking pretty good. But what do you do with that space from here on?
See, Nigel, unfortunately, we didn't follow the Hong Kong model, right? So therefore, our market cap of real estate companies has been minuscule compared to what happened in the magic period of Hong Kong or Singapore. And unfortunately, the companies in India have not given returns to shareholders. So it doesn't depend on the market, whether you invested in a DLF or a Prestige or whatever, your rate of returns have not been lucrative. Of course, one can argue that the Macrotech has done good post the IPO. There's no doubt about it. But broadly, in a longer term time frame, for whatever reason, I'm not attributing any motives to it, but somehow the other, the shareholder never makes return. Each of the promoters are phenomenally rich. The prices of real estate is up, and you see what kind of unaffordable space you guys can afford in Bombay. It looks like a different world altogether, Bombay, Lata and Nigel. But the fact is, how do the shareholders make the return? And I am quite surprised as to why over a period of 2 decades I've seen, we have not made returns, and the price of real estate has gone from where to where at the end of the day. So I don't know how to interpret this. Maybe somebody else can help me understand why investors don't make money in the real estate companies, but real estate prices keep going up.
We have been living in Bombay for decades, and we still don't understand this market. For millennials like us, we were discussing, just when we get ready to afford something, it becomes 50 lakhs more expensive, and then you can't afford it anymore. So Mumbai is a tricky one.
Houses. We've always lived in matchboxes. Okay.
And then you continue to live in pigeonholes. But Ajay, what do you do with some of these spaces that have done well and perhaps are in a structural upcycle, as per what many people believe? Autos, for example, right? I mean, coming out after years of a bear market, do you think the time has come to sort of put fresh money to work in spaces like this?
See, Sonia, as I said, the theory of glass half full is that there is no doubt that Indian economy has gone exactly the way global economy has gone, that the richer have got richer spending. The poorer, of course, will find it very difficult to buy discretionary items. And I'm not sure whether, it's going to come up in the numbers this quarter, next quarter. One is very clear that the bottom half of whether auto segment or any economic segment is going to struggling for demand at this point of time. So, yes, the upper tier, if you were to buy a Mercedes-Benz India, that would have been a phenomenal stock to buy in, because that's where the growth is. But if you were to buy a Hero Motor and with 60% of the lower end of the cycle, one would be diffident about it. So, question is, how much of the premium models and premium part of the company is the composition of your sale? If it's going to be high, I think like TVS has shown it, it's going to be phenomenally well to invest in auto sector. There's no doubt about it. But if you are going into companies with the lower end of the market is the primary focus, I think you'll have trouble. Broadly speaking, India's demand scenario is going to be terrible at the bottom end of the cycle. That goes for every company, I think. It's not just consumer, it goes for every other company. So one is to focus upon the companies where the products are bought by the rich and the upper tier segment. And that's the dilemma as to how do you spend the companies and break them into portions on every sector, whether it is banking, whether it is hotels, but even look at hotels. Only the 5-star hotels are going to make serious amount of money. It's not going to be the budget hotels. They're going to make money. Same is autos. The premium companies will make a lot of money. The bottom guys will struggle. And I think that differentiation, Sonia, will have to be maintained across all sectors. Economy sectors are in trouble. The premium luxury sectors are up for the best time ever.
So what would your advice be then, Ajay? Would you go for what, the Titans kind of stocks? I think that's what you're arguing for, premium products. And what, not equities as an asset class? Put money in fixed income because rates may rise and they give you an opportunity next year?
Lata, you nailed the head. Just hit it in the head. This is the best time to allocate, and you have not done it. A lot of investors have not done it for a while, to go into fixed income. If fixed income will give a better return, it has given better return. If you look at 5-7 years, it's given very good returns when you were in the last cycle of rate increases and you rode the whole capital gain right up to the point where post-COVID happened. I think the same cycle is happening. You will get better returns than equity markets broadly. And we've seen oversubscription of, just now we saw the bond subscribed at 7.9% interest for 25 years. Now, these kind of opportunities come once in a while. So there is a clear case that one needs to pedal down a little bit your equity inclination, no matter how exciting it looks, and move a lot of your money into the fixed income. And that's where they're given money. That's one. Number two is themes like power transmission, investment trusts, etc. Those have given phenomenal returns. So if those products come to the market, newer ones come to the market, they become better. You know, if you look at power investment rates of IndiGrid, etc., they have given a return of almost 60% over the last 2 years. And these are supposed to be quote unquote fixed income products at the end of the day. So, you know, I know it's less exciting. I know it is not the thing which gives you the kicks. But if you want kicks, go skydiving. Equity market perhaps is not the place.
We were asking Samir Arora yesterday whether he had any card parties to attend this Diwali, and he said, no, you know what, the stock market is enough for me. It's a place where I get all my fixes, all my highs. I don't need any more gambling, you know, for the moment at least. But Ajay, pharma used to be a space that you loved way back in the day. I mean, and today, even if you look at it, right, Cipla, Sun Pharma hitting fresh highs. This morning, in fact, Cipla, Sun Pharma, 52-week highs. It's gained already about 15-20% this year. Is there more scope here?
I think there are a lot of companies which are very undervalued in pharma space. Sonia, to be honest, so most companies have been valued at in a single-digit P's kind of stuff, and they will gain tremendously from rupee dollar depreciation. There is no doubt about it. But the caution here is that this flower is like the, you know, I don't know the name of the flower, but which once blossoms once in 20 years, somewhere in Himalayas or something. This pharma is that like flower. You need to catch it at the once in 20-year phenomenon. Yes, I was a great votary for pharma. We made good money, but then it became so sluggish that the return on capital employed became negative. If I look at last 20 years or 15 years, pharma has been the biggest loser in my portfolio in terms of return to capital employed. So, you know, yes, there will be a flower blooming in once in 20 years, but the fact remains that the sector has underperformed. Rupee dollar, now that's where the money is going to come in, is going to give the biggest kick to them, just like it'll give the kick to commodity companies no matter what you do. Pharma, unfortunately, another problem for India is being this, you know, the regulatory action which keeps coming. Now it's become more prominent. It's become in steel, it's come in oil, price cap. Now we saw the electricity regulator saying super power profits, power company profits should be curbed. So, you know, so if you have blockbuster drugs, if you price the drugs higher in India, you can expect government to come in. And that's going to be the biggest risk, if you ask me, to this market is, and why I said you need to get out of the stocks in time, is that moment a stock or industry does extremely well, now the road is open for the government with no guilt to say, I'm going to tax you, and come election year, that propensity will increase. So you need to be careful that sectors which do phenomenally well might have the government's attention to say, listen, you guys made too much money, give me some of it. Otherwise, I think rupee dollar should give a clear 10 to 15% edge to all pharma companies, no matter what the growth rate is.
Okay, all right, Ajay, always good hearing your thoughts. Thanks so much for stopping by.
Thank you very much.
And wishing you all the best for
you too, Nigel. Have a good year.
Okay, all right. Well, let's move on then. JSW Steel. Remember, those set of numbers were quite disappointing. Steel prices weakened, and they didn't really get the benefit of lower costs. To understand what went on in the past quarter and what's the way ahead, Mr. Sheshagiri Rao, the Joint MD and Group CFO, joins us. Hi, Mr. Rao. Good speaking to you. Well, it was a challenging quarter, right? But the street expects things to improve from here on. What kind of relief on the coking coal side particularly are you expecting in quarter 3? And will give us a broad analysis for quarter 4 as well.
Coking coal prices are very volatile. So from $650, they came down to $200. Now it crossed again $300. So that is a kind of variation in the coking coal prices in the market. But whatever prices as on date, if you take into account, and then see what is the benefit in cost that can come in the Q3 over Q2, then there could be $80 per ton of coal used in the consumption. That is the kind of benefit we are expecting to come in the Q3. As far as Q4 is concerned, depends upon the next 2 months how the coking coal prices will move from here on.
Okay, now let me come to the other raw materials, sir. Iron ore costs have cooled off, and you are also sourcing part of your requirement from captive sources, which is good news. Also, prices have stabilized, and does that give you a sense of profit on that front?
As far as iron ore prices are concerned, the overall reduction which has happened in the Q2, that has happened in phases, something in July, something in August, something in September. So the full benefit of lower iron ore prices have not flown in the consumption in the last quarter. So that benefit also will come in the Q3. So lower iron ore prices, lower coking coal prices, and also we have started our power plant which uses the blast furnace gas, which was getting flared in the Q2. So the lower power cost, that also will come in the Q3. So there will be a significant reduction in the cost over Q2 in Q3. That is what we expect, the reduction in the cost of production that can happen. As far as the steel prices are concerned, we are seeing stability in steel prices right now. So whatever fall that has happened in the last quarter, around 10,000 rupees lower realizations on a blended basis in the last quarter, that is what is the situation in the last quarter. Whereas the costs have not come down to that extent, even though iron ore prices, some reduction has happened, and only $40 reduction in the coking coal. Taking those two things into account, the fall in the cost of production in the last quarter was only 5,000 rupees or 5,100 rupees. So net we have lost in the EBITDA margin in the last quarter. Whereas in this quarter, we expect the steel prices to be stable and better volumes, and at the same time, costs are going to come down. So all this together, I think Q3 and Q4 of this financial year will be much better than what you have seen in Q2.
Okay, that's great news that Q3 and Q4 will be much better. Some reports indicate that domestic prices are at a premium to imported steel. Is that correct, sir?
No, there is a lot of misinformation saying that the landed cost of imports are cheaper than the domestic prices, which is not true at all. Even today, the FOB price of China is $580, $590 per ton. If you take another $40 as the transportation cost and multiply by 83 rupees, which is a rupee dollar, and if you have to pay 7.5% duty and then add the port charges and other costs relating to imports, then the landed cost is almost equal or maybe slightly higher than the domestic prices today. So if somebody is doing calculation, it's not correct. So if it is compared with the Japanese and Koreans, where they don't pay the 7.5% duty, their base price itself is higher. Therefore, the question of landed cost of imports are at a discount to the domestic price, I don't think it is correct.
All right, then we take your word for it, Mr. Rao. You believe that domestic pricing is on par with the imported steel, so we take that. But, you know, given all the factors that you've just told us, is it fair to assume that the standalone EBITDA per ton, say, trends from around the 3,500 rupees per ton to around 10,000 rupees per ton? Is that a possibility?
No, I don't want to say a number, but I can tell you that it will be much better than Q2.
Okay. Some more qualitative questions. International operations have been struggling in line with the global outlook itself. Now, what's your outlook and what's your strategy for US and European operations?
So in the case of US, if I look at the plate mill, it made a $24 million of EBITDA in the last quarter. So plate prices are reasonably at a good levels. They have not fallen the way HR coil prices have fallen. That is why the Baytown facility was operationally has done well in the last quarter. Then at the same time, as far as Ohio facility is concerned, HR coil prices have fallen quite substantially. And also the raw materials which they acquired at a very high cost, they have to provide in the books the fall in the prices. So both together, they made an EBITDA loss of $40 million. So out of that, a significant portion is towards inventory losses. So net, if I take 40 million negative in Ohio and $25 million positive in Baytown, so there was a net of 15 million loss from US. So in this quarter, what we expect, those inventory losses won't be there in Ohio. So it will be positive as far as the Q3 and Q4 are concerned in the US operations. At the same time, if I look at Europe, we made a positive EBITDA of 1 million euro. It is not very significant contribution as far as European operations are concerned. So we will remain at those levels in my view as far as Europe is concerned.
So any plans that you would have to slow down on your capex, and also what's the outlook as far as the debt is concerned?
This year we have slashed our capex expenditure by 5,000 crores from 20,000 to 15,000. But if you look at the debt position as on 30th September 22, it was lower by 1,500 crores when compared to 30th June. So even though there was lower margins, we could reduce our debt by 1,500 crores. So how it has happened of reduction of 1,500 crores, we reduced our inventories from 30th June to 30th September by 4,34,000 tons. Not only whatever we produced, we sold in the last quarter, and we could reduce our inventories. And our domestic sales volume was the highest ever in the domestic market. It is the highest ever. It was 47% growth quarter on quarter in the domestic market. It has crossed 5 million tons in the Indian market. So therefore, the debt levels are concerned. We have unwound the investments that have been made in the working capital. A part of it has come back. With that, we reduced our debt by 1,500 crores. But there is exchange rate fluctuation, translation losses to the extent of 2,500 crores in the entire 6 months. So if we take that 2,500 crores into account, the overall debt could have been lower by 4,000 crores, not 1,500 crores. But the exchange rate fluctuation has taken away 2,500 crores. That's why the debt has gone up to that extent.
Okay, Mr. Rao, for the time being, the street is listening to what you're saying. You're guiding for a far improved performance from here on. So we take that. But final question before we let you go. The Adani Group, they've been talking about making an entry into the steel market. What will your strategy be on assets that could potentially come up for sale? Maybe the RINL plant or maybe NMDC's Nagarjuna steel plant. Will you be a little bit more aggressive?
No, we are in the steel industry for a very long time. We are a strategic player. If any opportunity is there, we continue to evaluate. Whatever we feel is a reasonable value for that asset, we will submit a bid. There is always a competition, either existing player or a new player. So we have to continue to face that competition. I don't think we have to worry about that.
All right, Mr. Rao, always a pleasure speaking with you. Thanks a lot for joining in. That's JSW Steel. By the way, the market has now moved back into the green. The Sensex Nifty and the mid-caps are trading in the green. It's ICICI Bank that's batting from the front this morning, followed by something like a KPIT Technologies. BHEL is picking up a lot of pace, and United Spirits is up 3% after those good set of numbers that came through. So in the green for the market, let's slip into a quick break. On the other side, we'll connect with B. Ramesh Babu, the MD and CEO of Karur Vysya Bank, to discuss their Q2 earnings. We also have Prashant Kumar, the MD and CEO of Yes Bank, to decode their earnings as well. Stay tuned.